$7.4 trillion vanished in 24 hours. Not from a stock market crash, not from a banking collapse. From gold and silver, assets people buy specifically when they're terrified of everything else breaking. Something is catastrophically wrong when the safest assets on Earth become the most dangerous trade in a single day. January 31st, 2026. Silver plunged 31.4% in one session, the worst single day since 1980. Gold crashed from $5,600 per ounce to below $4,900, an 11% freefall that wiped out months of gains before most investors finished their morning coffee. This wasn't profit-taking. This was forced liquidation on a scale that suggests something massive just broke in the global financial system. The mainstream explanation you're hearing is simple and convenient. Trump nominated Kevin Warsh as the next Federal Reserve chair. Markets interpreted this as hawkish for monetary policy, and precious metals sold off because higher interest rates make non-yielding assets less attractive. Clean story, logical, completely insufficient to explain the violence of what actually happened. Because gold and silver didn't just decline. They collapsed with the kind of selling pressure that only occurs when massive leverage positions are getting margin called and liquidated against the will of the holders. The technical indicators told a story of extreme distress. Silver's relative strength index had reached 93.86, the highest reading since 1980, right before the crash. Gold's RSY touched 90. These are levels that scream overextension, but they also reveal something else. The sheer amount of speculative money that had piled into precious metals using borrowed funds. When you see a 31% drop in silver in a single day, you're not watching careful investors making rational decisions. You're watching forced sellers dumping positions to meet margin calls, to cover losses elsewhere, to raise cash immediately regardless of price. This is panic liquidation. Now ask yourself a harder question. Why were so many investors so heavily leveraged into gold and silver in the first place? What were they actually afraid of? The answer takes us 7,000 miles away to Tokyo, where something genuinely unprecedented just detonated in the bond market. On January 20th, 2026, Japan's 30-year government bond yields spiked above 3.9% for the first time since these securities were created. The 40-year bond yield surged past 4%, a level that simply didn't exist in the modern Japanese financial system until now. Japan's bond market is worth $7.6 trillion, and it just experienced what traders are calling the most chaotic session in recent memory. Prime Minister Sanae Takaichi announced snap elections combined with promises of aggressive fiscal expansion, tax cuts, and increased government spending. Bond markets immediately revolted. Yields exploded upward as investors dumped Japanese government bonds, demanding much higher returns to compensate for the perceived risk. This matters to you because Japan isn't some isolated economy. Their central government debt stands at 228% of GDP, the highest ratio among all developed nations. They owe more than twice their entire annual economic output. And for 3 decades, they kept this system functioning through one mechanism: interest rates at essentially zero. Japanese institutions, pension funds, insurance companies, and banks have been able to service this astronomical debt load because borrowing cost nothing. But that arrangement just shattered. The Bank of Japan raised rates to 0.75% in December 2025, the highest level in 30 years, and bond yields have gone parabolic in response. The 10-year Japanese government bond yield rocketed from 0.5% to over 2% in less than 6 months. 4 of Japan's largest life insurers are now sitting on $60 billion in unrealized losses on their domestic bond holdings, 4 times higher than the previous year. These aren't small regional players. These are systemically important institutions that manage trillions in assets for millions of Japanese citizens. But the real contagion vector isn't what's happening inside Japan. It's what Japanese investors hold outside Japan. $1.2 trillion in United States Treasury bonds as of November, more than any other foreign buyer, more than China, more than every European country. For 30 years, this was the greatest trade in finance. Borrow yen at 0%, convert to dollars, buy US Treasuries yielding 4 to 5%, pocket the spread. Free money with minimal risk. Hedge funds saw this and leveraged it 10 times, 20 times, generating returns that seemed impossible. Estimates suggest the total notional exposure in these carry trades could be $15 to $20 trillion. The math just broke. Japanese government bonds now yield 2 to 4% depending on maturity. Why would any rational Japanese investor take currency risk, send money overseas, and buy US Treasuries at 4.8% when they can buy Japanese bonds at home yielding nearly as much with zero foreign exchange exposure? They wouldn't. And they're not. The carry trade is unwinding. Japanese institutions are selling US Treasuries, converting dollars back to yen, and bringing the money home. This creates enormous selling pressure on American government debt, precisely when the US needs foreign buyers more than ever. The Federal Reserve Bank of New York didn't just notice this, they intervened directly, inquiring about currency swap costs between yen and dollars. The American Central Bank is now actively concerned about maintaining stability in Japanese currency markets, because if the yen strengthens too rapidly, it accelerates the carry trade unwind, which means more treasury selling, which means higher US interest rates, which means everything breaks. We've seen this movie before. In August 2024, the Bank of Japan surprised markets with a small rate hike. Carry trades started unwinding. Bitcoin crashed 23% in 3 days. The Nasdaq dropped 10%. Over $2 trillion evaporated in 72 hours. That was the preview. What's happening now is exponentially larger because the rate moves are bigger, the positions are more leveraged, and there's no obvious way to stop it without Japan reversing course completely. And every single one of those hedge funds that built leverage carry trades is facing the same brutal calculus. When you borrowed yen at zero and invested in dollar assets with 10 times leverage, a small move against you doesn't just erase profits. It triggers margin calls. Your broker demands immediate cash to cover losses. You don't get to wait and hope the trade recovers. You sell everything liquid right now to raise that cash. This is forced liquidation at industrial scale. Stocks, bonds, real estate investment trusts, commodities, crypto. Anything that can be converted to cash in hours gets dumped regardless of price. The fundamentals of those assets don't matter anymore. Microsoft could report record earnings. Doesn't matter. Apple could announce the greatest product in history. Irrelevant. When a hedge fund gets a $50 billion margin call, they're selling your favorite tech stocks, not because those companies are failing, but because they need dollars immediately to cover blown-up positions in Japanese currency markets. The correlation breakdown is already visible. Traditionally, when stocks fall, investors flee to the safety of government bonds. Bond prices rise, yields fall, and your portfolio stays somewhat balanced. That's the entire theory behind 60-40 allocation. 60% stocks for growth, 40% bonds for stability and downside protection. You watch what's happening instead. Stocks are falling, and bond yields are rising simultaneously. Both sides of your portfolio moving down together. The hedge is broken. Japanese selling pressure on US Treasuries is pushing yields higher, even as equity markets weaken. Your bonds aren't protecting you. They're adding to your losses. Ken Griffin at Citadel, one of the most sophisticated investors on the planet, just issued a direct warning about exactly this scenario. When bonds lose their negative correlation to stocks, when both move in the same direction during stress, bonds lose what makes them valuable in a diversified portfolio. You're not hedged. You're just exposed twice. Now layer in the second order effects that most people haven't considered yet. Regional banks in the United States are sitting on hundreds of billions in unrealized losses on their bond portfolios. They bought long-duration treasuries when yields were low, 1 to 2%. Those bonds are now worth significantly less because yields have spiked to 4.8% and climbing. Metropolitan Capital Bank just failed in Chicago. First bank failure of 2026. Not the last. When bond yields keep rising because of sustained foreign selling pressure, more banks holding underwater bond portfolios move closer to insolvency. Their depositors start getting nervous. Online banking makes moving money instantaneous. No lines outside buildings, no visible panic. Just silent digital transfers, draining deposits overnight. The Federal Reserve has already been quietly injecting tens of billions into the banking system with zero public announcement. 17 billion delivered to unnamed institutions the morning after Christmas. 50 billion injected on Halloween. These aren't routine operations. These are emergency liquidity provisions to banks experiencing sudden cash shortfalls. The silent bank run isn't coming. It's already happening beneath the surface. Here's what makes this different from 2008. Back then, the crisis originated in mortgages and housing. It was a US problem that spread globally. The Federal Reserve could cut rates to zero, launch quantitative easing, and flood the system with dollars to stabilize markets. It worked because the dollar was unquestionably the safe haven. Everyone wanted dollars during the crisis. This time the crisis is originating in the safest asset class that exists, government bonds, and it's being driven by the largest foreign holders of US debt systematically selling. If the Fed tries to cut rates dramatically to ease financial conditions, it risks accelerating capital flight. Why would Japanese or European investors keep money in dollar assets if US rates fall while their domestic rates are rising? Lower US rates could actually make the Treasury selling worse, not better. The Fed is trapped between two terrible options. Keep rates high to maintain dollar attractiveness, but watch domestic economy weaken and banks fail. Or cut rates to help the economy but accelerate foreign selling of treasuries and lose control of long-term yields. There's no clean solution. Every tool has serious negative consequences. Treasury Secretary Scott Bessent's response when asked about this at Davos should terrify you. He said he's been in touch with his counterpart in Japan and is sure they'll say things to calm markets down. Saying things. Not implementing policy solutions. Not coordinating intervention. Just hoping Japanese officials will verbally reassure bond traders and make the problem go away through sentiment management. When the Treasury Secretary of the world's largest economy is reduced to hoping foreign governments will talk nicely about US debt markets, you know the playbook is empty. The adults are panicking and they're out of actual tools. Meanwhile, half of all institutional money managers currently have zero downside protection in their portfolios, according to Bank of America. No hedges, no puts, no defensive positioning. Fully long, fully exposed, completely confident this resolves without major damage. Everyone is on the same side of the boat, assuming someone else will maintain balance. What happens when everyone realizes simultaneously that nobody's steering? When the first wave of forced selling triggers the next wave, which triggers the next? Markets don't move in orderly fashion during cascading liquidations. They gap. Prices jump violently because there are no bids. You can't sell at the price you see on your screen because by the time your order reaches the market, the price is already 5% lower. The velocity of this unwind will determine how destructive it becomes. Slow and controlled means markets adjust gradually over months. Fast and disorderly means wealth destruction that makes 2008 look contained. And right now, velocity is accelerating. The warning signs are flashing everywhere if you know where to look. Japanese 30-year bond yields hit 3.9%, a level that mathematically breaks the carry trade. That's not speculation. That's arithmetic. When Japanese bonds yield nearly as much as US treasuries without currency risk, the entire economic incentive structure reverses. The flow of capital that sustained global markets for 3 decades stops, then reverses direction. You're already seeing the beginning stages. Gold hit all-time highs above $5,500 per ounce in late January, before crashing over $700 in a single day when Trump nominated Kevin Warsh as Fed chair. That wasn't normal price discovery. That was leveraged positions getting obliterated. Margin calls forcing instant liquidation regardless of fundamental value. Silver plummeted over 30% in 24 hours, the worst single-day decline since 1980. $7 trillion evaporated from precious metals markets in one trading session. Think about what that reveals. Metals are supposed to be the ultimate safe haven during financial stress. But when hedge funds are forced to cover losses elsewhere, they sell whatever they can sell immediately. Gold becomes just another liquidation target. If safe havens get sold during panic, nothing is actually safe. The stock market is trading at valuations only seen twice before in modern history: the dot-com bubble and the COVID pandemic spike. Both times, bear markets followed. The S&P 500 forward price-to-earnings ratio sits at 22, well above historical averages. The Buffett indicator, Warren Buffett's preferred valuation metric, just hit an all-time high of 219%. Buffett himself said investors at these levels are playing with fire. Yet institutional money managers are positioned like nothing can go wrong. Half have zero downside hedges, according to Bank of America. They're not prepared for what's building because they've been conditioned by 15 years of central bank intervention to believe someone will always step in and save markets. Buy the dip has worked every single time since 2009, until it doesn't. Here's what you need to understand about your actual exposure right now. If you have a 401k, you own this risk. If you have a pension, you own this risk. If you own any index funds, any target date retirement funds, any diversified portfolio assembled by a financial advisor using modern portfolio theory, you are fully exposed to both sides of a correlation breakdown. Your stocks will fall when forced liquidation hits. Your bonds will fall when foreign selling overwhelms demand and yields spike. The hedge that's supposed to protect you during downturns breaks completely. You'll watch both sides of your portfolio decline simultaneously while your advisor tells you to stay calm and stick to the plan, because historically, this is just temporary volatility. Except historically, we've never had the largest foreign holder of US debt systematically selling, while domestic banks hide emergency liquidity injections, and the Treasury Secretary hopes foreign officials will say reassuring things to calm markets. The playbook that worked for the past 40 years assumed US government bonds were the unquestioned safe asset. That assumption is being tested in real time. And if it breaks, if global investors lose confidence in US creditworthiness or simply find better risk-adjusted returns elsewhere, there is no precedent for how that resolves. This isn't about timing the exact bottom or selling everything and hiding in cash. Cash gets destroyed by inflation if the Fed eventually restarts quantitative easing to stabilize the system. This is about understanding the structural forces in motion and positioning accordingly before the velocity overwhelms your ability to react. Watch Japanese bond yields. If the 10-year stays above 2% and 30-year stays above 3.5%, carry trade unwind continues. Watch the dollar-yen exchange rate. If it breaks below 140, that signals Japanese money returning home rapidly. Watch US Treasury yields. If the 10-year goes above 4.75% or 30-year above 5% despite Fed intervention, that's foreign selling overwhelming the market. And watch credit spreads, the difference between corporate bond yields and Treasury yields. When spreads start widening rapidly, that's the market pricing in default risk and economic deterioration. That's your signal that stress is spreading from sovereign debt into corporate debt and the real economy. The math here is brutally simple. Japan cannot sustain 250% debt to GDP with rising interest rates. Their annual interest expense will consume their entire tax revenue within years at current trajectory. They have to sell foreign assets to fund domestic obligations. That's not a policy choice. That's mathematical inevitability. 15 to 20 trillion in leveraged carry trades cannot unwind smoothly. The positions are too large, too concentrated, too interconnected. When margin calls hit, liquidation is forced and immediate. Orderly exit is impossible, and half the institutional money managing your retirement savings has zero protection in place. They're not positioned for this because their models, their risk frameworks, their entire analytical structure is built on assumptions that no longer hold. The question isn't whether this creates market stress. The stress is already here, visible in emergency-fed liquidity injections and bond market chaos. The question is whether it stays contained or accelerates into something systemic that forces a complete repricing of risk across all asset classes globally. You now understand what's actually happening beneath the headlines. The mechanics driving it, the math that makes it unavoidable, and why traditional portfolio diversification won't protect you this time. What you do with that information in the next 30 to 90 days will determine whether you preserve wealth or watch it disappear into a forced liquidation you didn't see coming. The $7 trillion crash in gold and silver wasn't the crisis. It was the symptom. The real disease is a global financial system built on 3 decades of free money finally confronting the reality that free money always has a price. That bill is now due. Japan's bond market breaking, carry trades unwinding, treasury yields spiking while stocks fall, banks quietly receiving emergency liquidity, institutional investors with zero hedges. These aren't separate events. They're all manifestations of the same structural fracture. The foundation is cracking. You can't stop mathematical inevitability with hope and reassuring statements. When the numbers don't work anymore, the system adjusts violently until they do. The only question is whether you see it happening and position before the adjustment accelerates, or whether you're still holding a fully exposed portfolio when everyone tries to exit simultaneously. The warning signs are flashing. The math is clear. The velocity is building. What happens next depends entirely on how fast you move.